Now, this story started way back in January 2021. You see, COVID crashed a lot of businesses. And after COVID, the late Bobu, who was a very respected advocate, he was a law lecturer, he needed capital to start, to sort of, boost his business. And he went to a lending institution called Hypac Investment Limited. And they agreed on a loan. And this loan had very interesting terms. It was 15% interest per month, 15% of the money borrowed per month. Now, for any late payments, he was going to pay 5% as a weekly penalty if he has not paid. And just to secure themselves, Hypac said, we will take your home as collateral. So you can actually see the terms and conditions. We always say terms and conditions apply. Now, if you do the maths, you can obviously see the interest around here was in excess of 400% per annum. And when it is compounded. And that's why if you are a borrower, it is critical to understand the cost of money. Because if you understand the cost of money, and somebody is lending you 400% per annum, yet your SACCO is lending you at 12%, or the regulated bank is lending you at 18%, I am in doubt whether you would actually go to that institution lending you 400%. And we've always said there's a calculator online, calculator.co.ke, that you can actually be able to use just to check. And the way to check is just put in all the terms and conditions and see what is my total payout. Compare the total payout with what you receive. So a lot of things in the business world is what is called buyer beware. I think in Latin, today we are speaking Latin, it's called caveat emptor. Buyer beware. It's not the business of the lender to tell you everything. It's your business to be well aware. So this gentleman borrowed the money and he paid. Yes, and like we say in our language, he paid and he paid and he paid. And he paid 22 million in total. And that was obviously double the original loan that he had taken. But the lender said, that's not enough. You still owe us 69 billion. And at that point, they moved in and they took the home. Remember, the home was the collateral. Because now this gentleman is saying, we paid, and they're saying, no, you've not paid. So they take the home, and they had secured it. And so the lawyer decided, I understand law. He went to court. Then the matter drags on, obviously. Sometimes things in court drag on. And then, unfortunately, in September this year, while the case was still pending in court, he was shot by a known gunman on Magadi Road, and he died. And I think that's the part where this whole issue became public. But in November this year, this is just last month, the Honorable Justice Moses Addo delivered the judgment. Now, this judgment was delivered posthumously because the person who went to court had died. And this has gotten a lot of awareness and has become a game changer in the Kenyan debt market. So it is important to understand, what did the judge say? What was the ruling? Now, the ruling was very simple, very straight, very easy to understand. The judge said the terms that were given to this person were illegal and they were unconscionable. That means they are unreasonable. They are unfair. They are not reasonable because they are oppressive. So that's the first thing the judge observed, that you remember that 15% per month and a 5% interest every week if you don't pay, and the house has been taken as collateral. He said that's oppressive. And if you look at it, that's oppressive. Then the judge reminded them that there is the In Duplum rule, and that In Duplum rule applies. That once the interest is paid, once the interest paid equals the principal, there's no more interest to pay. That's the end of the story. So the debt was fully certified when 22 million was paid, because 11 was the million and another 11 was the interest. So at that point, the loan was fully paid. And so the judge ordered that Hypac and I think Family Bank, who had a charge on this property, they have 30 days to return the title and discharge it. So they must give back the home to the family of the late Bobu. And they have no further claim. There is no other claim that is enforceable. They cannot recover any one more shilling from that family. So that's what the ruling was. So now it's good to understand, what does this mean to you as a borrower. If you are a borrower, what does this mean to you? Because it's important to understand what it means. Now, say signing a contract does not mean you have waived your rights. He signed a contract of a very unfair arrangement.
Yeah.
So that does not take away your right. They can't just say you signed, and there are many times when people sign when they are not aware. But again, remember what we said about caveat emptor, buyer beware. Before you sign, try to be aware. Try to be aware. And this is why I say sometimes you need to work with an expert.
Yeah.
If you're signing in a mortgage contract, a long-term mortgage contract, you need an expert who can interpret this thing for you. If you're signing a big loan, we've seen a situation where families have lost their homes because in signing the agreement, sometimes, you're told to put in a personal guarantee while you're looking at a commercial loan. When you sign in a personal guarantee, most likely what you're using as a guarantee is your personal home. So when the loan doesn't pay, the institution finds it easier to call in your personal guarantee because it's easier to dispose it.
Yeah.
And so I've seen a family lose their 300 million home.
Look at that.
So it is important. It doesn't waive your rights, but beware, okay? Because it means courts will intervene if you have been given predatory terms. So if the terms are predatory terms, mean they're eating you. I mean, a predator, what does a predator do? They eat, isn't it? So they're eating. And so the In Duplum laws says once the interest you paid is equal to the principal, that's the end of the story. That's what we need to do. And so this is why when you borrow, document everything. Keep your receipts. Keep your statements. Do your reconciliation. And before you sign, get somebody to interpret for you. But if you are the lender, because some of us are the lenders, then don't offer terms that are not right, that are unreasonable, because they will not be enforced by a court of law. The court of law will not enforce it. Exploiting somebody's distress will cost you your entire debt. Because if you look at this situation, I would want to imagine for somebody to take a loan with an interest rate of 400% per annum, they must have been under distress.
Yeah.
They were desperate for money. But the lender, if you're the lender and you actually just put in somebody in that situation and you lend them, there's a chance of even losing your money because then you will not be able to get the debt as you are. So, and you cannot secretly deal with your collateral and sell it because that's breach of trust in law. So fair lending is not optional. It's a law. It is a law. And so we're saying to the late Matthew Chalo, we're saying rest in peace. He put in a good fight, and it was not in vain. Although he's not here, it is not in vain. That ruling, it will protect a lot of thousands because now social media has highlighted it, and a lot of people now understand where this ruling has come from and what it is all about. And it's a big reminder that we have legal safeguards in this country that are anchored in a law. When we sing our national anthem, we say, justice be a shield and defender. And justice remains a shield and defender when it is applied. So if you say, in summary, the In Duplum rule is a fundamental legal principle in banking and credit law, and it is designed to protect borrowers from excessive interest accumulation. Its core purpose is to protect exploitation of the borrower when they take a debt. And so when you're thinking about that In Duplum law, when you look at the features of this In Duplum law, the core principle is that says the amount of interest charged on a loan cannot exceed the outstanding principal at any given time. So you cannot charge more interest than the principal that somebody has taken. So once the accrued interest reaches the principal amount, then you cannot accrue more interest. You can't charge more interest. It stops. Okay, so that happens. And there's a huge legal basis on this because this rule is now codified in Kenyan law. Codified in Kenyan law means it is part of law. It is specifically written in law. So we're not just applying it. It is part of the Kenyan law. It is in the Banking Act, Section 4 of the Banking Act, and it applies to all licensed banks and financial institutions. Now that's important because it does not apply to unlicensed individuals and entities. And that's why you need to be sure of the legal status of the lender. It doesn't apply to the individual. Okay. It might actually not apply to some of the predatory lenders. They may not be able to enforce, but before they enforce, by the time you get to enforce, now you will have challenges around that. So the origin of this rule is not something modern. This is something that has been there all along. And it is very, very deep-seated in what we call the common law principle. Now, just maybe a lesson in law here. The Kenyan Constitution is what we call a Judeo-Christian law. Our law comes from Judaism. If you look at our law, the laws of Moses are somewhere. If you look keenly, you're actually going to see all these things. Thou shalt not kill. You know, thou shall not steal. You know, all those things are codified in there. And so, if you look at development of humanity from Moses, and then we came into Christianity, and you know, Rome was very, very strong then. And we have what we call the Roman Dutch roots, the people who actually codified law and made it much stronger. And then that is later codified in Kenyan law. So that's where it comes from. So it has a long... So if you look at origin and evolution, like I said, it comes from the common law, Judeo-Christian law, then it comes to the Dutch Roman law, because the English people obviously came from the continental Europe before they went to England. So that has influenced that, and then it is infused with what we call African legal systems. Long before the British came, every one of the communities we had a system. Maybe we were not loaning, modern day loaning, but there was always a way of loaning stuff. Okay, I mean, I would maybe bring my cows to your place and they would stay in your boma, but there was a way of what I would get back and what would be left behind. And I think that was common everywhere. Now, Kenya was obviously a British colony, and so we inherited the English common law. And you know, Britain does not have a written constitution. They have what they call a common law. Okay, so they don't have a constitution as we have. They are monarch constitution, and that's why the king or the queen is sovereign. They are like the source of the law. So this was the In Duplum rule was recognized as a general principle of equity. It's a rule of fairness in common law that is going to protect borrowers from unscrupulous lenders, so that they don't accumulate a lot of interest, so that it gets there. But now in Kenya, it is written as a specific law. And this name In Duplum is a Latin word. It means double. Actually, it says in double. When you're saying In Duplum, you're saying in double. So you can only go to double. The interest and the principle. Now, in terms of judicial adoption and development, this is not something new. I think the first time there was a ruling, very, very similar ruling in Kenya, was in 2001. And this was based on common law. This was a landmark case, I think was in Kenyan jurisprudence. There was somebody called John Mwangi and another. They sued the National Bank of Kenya in 2001. And this is somewhere in the Kenyan law report. And in this case, the Court of Appeal, which was the second highest level at that point, authoritatively stated that the In Duplum rule is part of the Kenyan law. Although it had not been specifically put in law, they said it is a Kenyan law. And the court held that the interest must stop running once the sum paid is equal to the principal. So I think John had taken the bank to court because it was a loan. Now, just to make things clear, this law was now codified, and that became the turning point. So it became part of the law. So the rule had existed in common law. Now, Kenya doesn't use a lot of common law because we have the constitution and we have the laws of Kenya. So we like getting everything into our law. So it was inconsistently applied because when it's common law, sometimes it's a function of who understands what. So it was in different parts. So to provide, to make it stronger, to make it uniform through the country, Parliament now decided to codify it into a statute. So it is an act of Parliament. And this was done from the Finance Act of 2006. I think we understand the Finance Act now. This is how we get our finance issues properly done. And it was introduced as Section 44A of the Banking Act. But the Banking Act is Chapter 488 of the laws of Kenya. And that's what governs how the banking industry is run. And this move now transformed the rule from being flexible in doctrine to being clear and being mandatory provision, so that all banks and all financial institutions are governed by the rule. Now, it's not a feeling, it's not a thought, it is the law. And the statutory fashion is actually very, very strict. It's more stricter than the common law, because now the common law only capped the interest. The statute now, this section 44, does not only cap interest, you have also got to consider other charges and penalties, because you know you get charged many other things, a lateness fee charge. So it's saying you do not only say principal and interest. No, you say principal and all the other charges. I think the only thing that are removed are things like legal fees or insurance that's payable. So it makes it much more secure for the borrower because many things are taken. So it's got a broader cap and offers more borrower protection. Now, the law gets tested all the time. So this matter has actually now even gone to the Supreme Court. So, and this is the most authoritative institution in terms of law in this country. So somewhere in 2021, I think an institution called Mid-Africa Limited took savings and loan, another institution, into the Court of Appeal. Into the Supreme Court. This is in 2021, and it is in the Kenya Law Report. And so the Supreme Court made a few clarifications. They said this rule applies when a rule is non-performing. When you're not able to pay your debt, the rule applies. So they cannot say the rule applies when you're paying. No, even when you're not paying, it applies. And now the cap includes to all accrued interest and all the levies that you penalize. So it is not only just the interest, it is all the levies. And once the cap is reached, interest and penalties stop accruing until the payment is made. But when you pay, now whatever amount you pay does not go to the principal. It goes to pay the levies first. So that's what it says. So when you're paying now, whatever you pay, it goes to the principal. So that's I think that helps us to understand what it is capping. We say it is capping interest and penalties such as late payment fees. If you have bounce check charges, if you have other penalties, that does. And so we're looking at the total principal according to the principal. Now, what triggers the rule? When your loan stop performing, you've been paying and something has happened and you stop paying. Now, this rule comes into place. If you're not paying and the interest is going up, once the interest gets to the principal, that comes to the end of it, and that becomes, so your loan is overdue. So in terms of the practical effect, once a borrower defaults, the bank cannot continue to charge interest and penalties indefinitely. And I think that was the biggest challenge. And I think I've seen this many times when people say, I think I've seen one case where somebody said, I borrowed 120. They actually gave me 60. They told me the other 60 was processing fee. Yeah. Then they charged me penalties. I paid 400,000 and they're still asking me for more money. Now this rule, unfortunately when people are not aware, they get subjected to those situations. Because if you borrowed 120, why are you paying 400? Where is it coming from? If you understand this rule, and that's why we trained so many lawyers in this country, so that they can actually be able to help us. Because the maximum recoverable amount in the interest and penalties is limited to the outstanding principal. So it cannot be more than the principal. So the total debt, when you're talking about the principal and the interest, cannot exceed double the principal amount. So if you borrowed 120, you cannot pay more than 240. And that's where the In Duplum, the double rule, comes from when you're saying in double. And this cap remains in place until the borrower makes a payment, but when every payment is made, it goes to the accrued interest and the penalties. So I think that's where the challenge can be. Sometimes you're paying the interest and principal, and it's coming down. So what's the purpose and what's the rationale? The number one purpose is consumer protection. You want to shield borrowers from oppressive, ever-growing debt because it's very easy for the debt to keep spilling out of control. The other rationale or purpose is fairness. You want to ensure that penalties are proportional and not punitive. Yes, if you don't pay in time, you should be penalized, but should not be very excessive. Of course, the other one, it encourages resolution. It is an incentive to lenders to actively engage with the defaulting borrowers, because if they have lent you and you can only collect so much, then they are better off engaging you so that you stop paying. You know, if this rule was not there, they will not be worried. The more you stay not talking to them, the more you will eventually end up paying. So it becomes, it encourages them to be able to borrow, to engage so that they would recover their debt, other than expect the penalties to balloon and the penalties will not be paid. So the rule does not apply. I think it's good for us to also agree. The rule does not apply to charges that are not penalties. We said it doesn't apply for legal fees if you have legal fees to pay. It doesn't apply to insurance premiums. It doesn't apply to commissions if they are stated in the loan agreement. So it doesn't apply. So when we are working out how much, well, those ones are obviously left out. Interest that accrues during the normal performance period of the loan does not apply. So you've got normal interest, you're paying very well, then there's no issue. So what we are saying here, if we illustrate, if you have an outstanding principal of 100,000 and you default, the bank can only charge you up to 100,000 in combined interest and penalties. So once the cap is reached, no further interest or penalties can be accrued. So if you borrowed 100,000, the maximum you can ever pay is 200, not more than 200. You can, but again, I must emphasize, this does not cover everybody.
Okay.
And so that's why we want to encourage people, as much as you can, borrow from the regulated sector of the economy. So in essence, the In Duplum rule is a critical debt safeguard in Kenya, so that when you default, your debt does not grow indefinitely. So that you can obviously be able to service your debt and be able to do the things that you intended. Because we have many reasons why we want to borrow. But we always say in the borrowing sector, you need to ask yourself when you're borrowing, is it a good debt or is it a bad debt?
Yeah.
It's a good debt if it improves your financial future. Because you take in the debt, maybe you have invested where you're getting a return. You have invested to create your capacity to earn more. It is a bad debt if, in fact, it's a good debt if you have a way out. If you're not able to pay, there's a way out. If you took a car loan from the bank and you're not able to pay, you give them back their car. If you took up a house and you're not able to pay, you sell the house, pay them the balance, and keep whatever there is for you. Now, it is a good debt if the interest is reasonable. It's a good debt if you can afford to pay. You know, you must be able to say, can I afford? Because if you can't afford, it's going to put you in trouble. Yeah. It is a bad debt if the interest is excessive. In this case, it might qualify as a bad debt. The interest rate at 400% is very, very punitive. And that's why we say to people, build your capacity where you can borrow reasonably. That's why you should belong to the circle. I think it's a safer place. Yeah. That's why you need to belong to the chairman. That's why you need to have a good relationship with your bank, because then you can be able to borrow reasonable. Now, it's a bad debt if it's a consumer debt. You cannot, it is not productive, it is not giving you results. And many times, by the time you pay it, you cannot even see what you're paying for. You know, if you went to for a party with your friends and you bought them drinks, by the time the bill comes, you can't see what you paid for. Yeah. It's all consumed. It's a bad debt if the interest rate is very, very high. It is obviously going to be a bad debt if you can't afford to pay it. So it is critical for us to think about it. We need debt to get us leverage to be able to move much faster, but we need to be careful because it can actually destroy us. But I think now we have seen one of the safeguards we have in law that's going to help us. So the In Duplum rule is a safeguard for the borrower, but the borrower needs to be aware of how the loan is functioning.
Well, thank you. There is a question here.
Yes.
Thank you, Bramwel and Mr. Wahome, for focusing today's discussion on the issue of the debt and the interest within the framework of the principle of the In Duplum rule. Mr. Wahome, is the In Duplum rule ingrained in the Banking Act? If so, why do banks and financial institutions seem to ignore it? Could there be loopholes in the law to the lender's advantage?
Is it ingrained in the bank? I think we have clearly said where it is. It is Section 44A of the Banking Act. So it is actually a rule in the Banking Act, and it is binding to them. Are they applying it to the letter? Sometimes, I think largely yes, but sometimes they don't. Okay. This is where buyer beware. Yes, you need to know so that if you see, and again, there are many things that happen that should never happen. Yeah. You know, if your loan was due on Saturday, most people want to pay it on Friday. If you pay on Friday, the money doesn't get credited. You remember on Monday, the money is not credited in your account. Yeah. You can be penalized for not paying. Okay. But where is the money? It is with the bank. Yeah. Isn't it? But when you're conscious, when you're looking at your loan statements and you raise the question on Monday, why did you guys credit? They're saying, oh, sorry, it was a mistake. What if you don't? you must always remember you're on your own.
Yeah.
Yes. You must remember, so you check. So if you understand the rule, when it gets to that point, you point it out to the bank. This is what we are going to do. This is what the rule says. So it is part of the Kenyan law. Like we're saying, it is not now common law. It is statutory law. It is clear, written in the law. Yeah.
All right. And he or she goes ahead to ask, so should lenders be paying simple or compound interest on loans?
That's what you have agreed with whoever is lending you. I think that now is part of the agreement you have with whoever lends. The law does not now determine that. The law is determining the total interest payable, and that is why when we're looking at interest, we're looking at levies, we are looking at penalties. Those levies and penalties is what he's saying, compounding. If you don't pay, interest goes up and you get penalized. If your check bounces, you get penalized. So the banks obviously have a space where they can be able to penalize for those things.
All right.
Yeah.
So what you are telling us this particular morning, Mr. Wahome, is that in as far as loans are good, but number one, I must ensure that I take some of these loans or the loans I intend to take within the regulated environment, so that I can, this particular rule can actually cover me in the event of anything, right?
Yes, that's true. We're saying to people, first understand, you must have the need for the loan.
Yeah.
Don't take a loan because it's offered. You must have a need for it. That need is critical. Is it going to build your financial future? Because if it is not, the loan will give you trouble.
No.
Number two, borrow it from a licensed provider, because then you are covered by this rule. Number three, get to understand the terms and conditions. Even if you need a professional to work with you, there are people who've gone to college actually, and they are certified credit professionals. I think that's their qualification. They can actually sit with you and walk you through. There are people who actually compute interest rates. They can help you to do the interest rate. Yeah. There are lawyers who can help you. So that you need to be very clear, especially if you're going to big debt, you need to be very clear of what the terms and conditions. If I default, what will happen? So that then you're very clear and you're safeguarded.
All right.
Yeah.
Well said, Mr. Wahome. And that is a reason enough for you, my dear listener, to just get some of these nuggets of wisdom in today's class. Mr. Wahome, remind us about the class and what is it about and how they can tap into that.
Thank you for that. Part of what we have borrowed today, or the In Duplum rule wasn't there, but part of the other things we have borrowed, Chapter 7 of the rule.What.
Yeah, okay.
That's where we deal with all issues around the debt, and a lot of these things are there.
Yeah.
Now, we said you want to change your family tree and you want to teach your children about money. A lot of times we say you give them what you have. And tonight we are saying come, because we want to become better money managers. That's all we are looking at, how to become a better money manager. And so you can get in touch with us on 0708 150 137. 0708 150 137, so that now we can spend some time saying, how can I be an effective money manager? So that even as I'm teaching my children, now I understand how to go about it.
All right.
Yeah.
Thank you so much, Mr. Wahome, for your insights this morning. I really look forward to next week. Asante sana.
Most welcome.
And to Leah, thank you so much, Leah, for your suggestion about this topic. I do believe that Mr. Wahome has answered you and has educated all of us in regards to this particular principle. My dear listener, feel free, even tomorrow, if you have any other suggestion that you want Mr. Wahome to tackle, feel free. I will let him know about your area of interest. But in the meantime, today's class, tap into that class, my dear listener. All right, 0708 150 137. That is the number. Get in touch with Mr. Wahome. He's ready to work with you together with his team. But most importantly, remember what we are talking about here. Mr. Wahome has put it down in a book for you and me. All right, read the wallet words. I'm telling you, it's gonna blow your mind. All right, that is exactly what I want you. So call Mr. Wahome and request for that particular book before anything else. By the way, you will love it. it. All right, take it as by word. You are going to love that particular book, and give it to your son or your daughter as well. Okay, yes, that is exactly what we are doing. We are not just building generational wealth, we are passing on information and knowledge to make them good stewards. And how are we doing that? By getting them a copy of the Wallet Words, authored by Mr. Wahome himself. All right, so get a copy. 0708 150 137. Thank you so much for your time, my dear listener. My time is up. Thank you for your company. Let's do this again tomorrow, God willing, and being a Wednesday, Grace will be here to talk to you. Have a productive Tuesday.
This is Radio Wahome 88.3 FM.